So on the privacy side, if you run an agent on a transparent blockchain, everything it does is visible to the entire world. That's actually fundamentally flawed because every trade, every strategy, every credential, it's a competitive intelligence leak. The infrastructure layer tends to capture the most durable value, AWS capturing more profit than most of the applications running on it. In the agentic economy, that's just my personal opinion, I think we'll see something similar play out. Whoever controls settlement, identity, coordination rails will have a structural advantage. AI crypto is actually, several distinct markets. Institutions shouldn't make the mistake of just dismissing the entire space because there is some fluff projects in the space. It's like dismissing Amazon in 99 because pets.com failed.
Today's guest is Alexander Scharrer, Head of Capital Markets at Near Foundation. We get into whether AI agents will start competing with humans for capital, who actually captures value in an agent-driven economy, and whether decentralized AI can realistically challenge the dominance of big tech. We also break down the real investment case for Near, why the market may be mispricing it, and at the end, what happens if this entire AI crypto thesis turns out to be wrong. Alexander, welcome to the show.
Hi Nasib, thank you for having me.
So, what led you into crypto and what made you focus specifically on capital markets?
Sure. So my background is actually in traditional finance. So I started my career at Goldman in London. So I worked in investment banking first, then in asset management, then in private equity. And across really any of those roles, I kept running into the same thing. So the traditional finance system is incredibly slow, full of friction. Settlement takes days. Cross-border payments are expensive and opaque, and reconciliation is a nightmare. So always thought that there has to be a better, more efficient way to do this. And the actual crypto rabbit hole started in 2016. So I had a friend of mine from university had invested in the Ethereum ICO back in the days, and at the time, I generally thought he was insane. But I kept following it more as a hobby at first, investing personally and learning more about DeFi, and then watching the ecosystem evolve. And at the same time, I did my master's at Tsinghua University in Beijing through the Schwarzman Scholars Program, and I focused heavily on blockchain and AI. And after that experience, I decided I wanted to double down on crypto. So I spent a lot of time at first in the Solana ecosystem, and then really discovered Near. And what drew me in was the origin story, right? The co-founder who literally co-authored the Transformer paper, building a blockchain designed for AI from the ground up. So I really thought, the tech stack was impressive, the ecosystem was growing, and yeah, the thesis really appealed to me in a way few other projects did. And so I joined the foundation as a BD person in August 2022. And then really the capital markets focus came naturally from there. I kept seeing the same gap I'd noticed at Goldman. Really great infrastructure being built that institutional capital couldn't access at scale. So no regulated products, no custody frameworks, nothing really that fit into the existing allocation model. And so I focused a lot on those bridges, ETPs, ETF filings, institutional roadshows, and at the early stages, you really needed someone that had to translate between builders and allocators. And having sat on both sides of that table, really, made it easy for me and gave me a perspective that's useful. Obviously, that gap has now narrowed massively. And today, I work across two tracks at Near. I work on Near Intents, basically our universal cross-chain trading protocol, where I lead institutional deals. So bringing in, larger trading firms, exchanges, payment companies, RWA providers, etc. And then on the capital market side, I'm focused on launching institutional products, managing investor relationships with VCs, our backers, liquid funds, and facilitating everything from ETPs to wrappers for traditional finance.
Mhm. And before we jump into Near Intents, I wanted to talk about the company itself. So Near started as an AI research effort and only later evolved into a blockchain. Now, how much of the current architecture is still shaped by that origin, right? And where does it meaningfully diverge from traditional layer one design philosophies?
Yeah, it's a great question. And honestly, I would say this is the single most misunderstood thing about Near. Most people assume we pivoted in AI in 2023 when it became trendy, but the reality is actually quite the opposite. So Near started as an AI company back in the days. It was literally called Near AI. And so
Mhm.
our founder Ilya Polusukin co-authored "Attention Is All You Need," which I
Mhm.
just mentioned, right, at Google in 2017. So that's the original Transformer paper. So the architecture between ChatGPT, Claude, Gemini, and really every other AI model running today. I believe it has over 170,000 citations. So it's actually one of the most important papers of the 21st century. And so after leaving Google, Ilya and his co-founder Alex Skidanov started Near AI to build or basically to teach machines how to code, right? What we nowadays would refer to as vibe coding. And so they needed back in the days needed a way to pay research contributors around the world to provide the training data. And so those were mainly, students in Ukraine, China, Poland, like all across the world. And the current the payment system back in the days wasn't really set up and fit for purpose. So what do engineers do when they encounter a problem? They build something. And so this is basically how they built and came how Near Protocol came about. They thought it would take 6 months to build this. It took 2 years, and Near Mainnet launched in 2020, and we haven't had a single second of downtime since then. And so going back to your question, I would say like the I origin shows up everywhere in the protocol design in many ways most people don't appreciate, and where Near meaningfully diverges from the other traditional layer one designs is in what it optimizes for. I'd say like most layer ones are designed around validator economics, DeFi composability, etc. But really at the core, they're optimized for human traders interacting with smart contracts. And Near is really optimized for machine to machine interaction at scale. So, with sub-second finality, we can have a theoretical throughput beyond a million TPS. But more importantly, I would say the intent-based execution model really means that agents they don't need to understand the mechanics of every individual chain. And if you think about it, if you want to build for the agentic economy, they need to be able to transact across different payment rails, blockchain ecosystems, etc. And this is really what we're building towards. And that's a fundamentally different design philosophy from other traditional layer ones, where the user has to specify exactly how a transaction will execute. So I would say in a nutshell, that's the main difference.
What's the core problem you believe existing blockchains fail to solve when it comes to AI?
I think a couple. Um, Probably the two most common ones are, I would say, privacy and commerce. So, and if you don't have both, you don't really have infrastructure layer for autonomous agents, right? You just have a ledger that agents happen to use. So on the privacy side, AI agents, in order to be effective, they inherently need to handle sensitive data. So credentials, trading strategies, financial positions, all our personal data, right? Right, to be really effective. And if you run an agent on a transparent blockchain, everything it does is visible to the entire world. Now we in blockchain have sort of come to accept this fact, right? That this is how it is, but that's actually fundamentally flawed because every trade, every strategy, every credential, it's not only a privacy concern, but it's a competitive intelligence leak. If you think about institutions, institutional trading desks have had execution privacy for decades, right? It's one of the main reasons serious capital has stayed on centralized infrastructure rather than moving on chain. And frankly, it's rational behavior, right? Like why would you broadcast your strategy to the world? So Near really solves this at every layer of the stack. I'd be happy to talk more about our AI stack, where we basically can run inference inside trusted execution environments. It's hardware enforced, where even the operator can access your data. And then on the intent side, we have something launched called confidential intents, where essentially you can launch confidential swaps, routes, transactions through a dedicated private shard. And so validators just process transactions without being able to read them, and everything stays confidential end to end. So that's on the privacy side. And then on the commerce side, I would say, and this is going back to my earlier question, to my earlier point, agents need to express desired outcomes find counterparties, settle payments around the clock, around um, across different chains and borders, right? And so traditional blockchain transactions are completely imperative. Like you choose a wallet, select a chain, find a bridge. I mean, we've all been through like the hoops of that, right? It's really cumbersome and there's a lot of friction. So we think near intents inverse that entirely. Basically, blockchains and agents need to be able to declare what they want and basically find a way to execute it optimally across different chains without having to think about how to bridge assets, wrap tokens, how to pin the native gas, etc. So I would say like the punchline is really most blockchains were designed for humans clicking swap buttons, and Neo was designed by people who build AI for a world where agents are the primary users of the network.
And from an institutional perspective, what is the actual investment case for Near today beyond the narrative of AI plus crypto?
Yeah, it's a question that I get a lot when dealing with investors, VCs, liquid funds, etc. There's a few themes. I would broadly categorize it into three different buckets. I would say it's the live traction and product market fit. It's our tokenomics and then the institutional access. So on the traction product market fit, Near Intense has now settled over 16 billion in cross-chain volume across, we're now live across 35 blockchains and 150 assets. And it's currently doing like roughly 2 billion a month in volume. And so that's real economic activity, right? Generating revenue for us and for an ecosystem of our partners. And so, we have a strong integration base with like different wallets, DEXs, aggregators. And then on the AI side, we've been working on a bunch of different things as well. Happy to go into more detail after that. But basically, there is clear product market fit on both sides. And I think for investors, it's really important to see if you look at the layer one landscape and you have a lot of layer ones that are now like 5, 6 years old. A lot of them have raised a lot, have huge treasuries, but there is very minimal activity happening on the chain. That's becoming a real problem. So I think for us, it's been really exciting to see that we have found product market fit with our products. We are actively generating revenue,
Mhm.
and a lot of investors are still catching up with that fact. But I think it's one of the core, um, the most important points in terms of what's the narrative from here. The second one is definitely tokenomics. So we have halved our inflation from 5% to 2.5% last year. The Compared to many other layer ones, our supply is actually fully unlocked.
Mhm.
There are no cliff events, or surprise dilution events coming up and waiting around the corner. So that's a very different story from many other layer ones.
Mhm.
And then one more thing is that we have switched on the intense fee switch. That's what we refer to as basically we when we integrate with different distribution partners, we do a revenue share by default, and the revenue that goes back to us is used to buy back near from the
Mhm.
market. So, we are currently cash flow positive with the treasury. The inflation story is we have half the inflation, and we are actually, going or moving towards deflationary, which net becoming net deflationary, which is a dynamic most layer ones can only talk about hypothetically. So that's around the tokenomics. And then the third point that I mentioned is institutional access, right? We have ETPs live on many European exchanges. So with Bitwise, 21 shares, a Valor version, we have a Grayscale Near Trust. We actually part of the Grayscale Decentralized AI Fund together with BitTensor and a couple of other protocols. And then we also have an ETF that is being filed in the US. And then also, of course, we have our own near digital asset treasury, which is called Sovereign AI, listed on Nasdaq. So yeah, I would say overall, like great product market fit and traction on that front. Tokenomics story has really evolved, and then there is a strong institutional access at the moment.
What does institutional usage of near intents look like today in practice, and who are the users, right? And what are they doing with it?
Yeah, it's a good question. So the majority of the 16 billion in near intense volume has been driven by retail so far, and that's
Mhm.
been coming from it's mainly volume from our own front end, which is
Mhm.
near.com, or through integrations with companies like we are integrated with SwapKit, we're that with Ledger, Trust Wallet, BitGet Wallet, ThorSwap, CowSwap, LeFi, Rango, you name it, right? So we have a bunch of these, like what I would call like B2B2C and B2B2B2C integrations. And in addition to that, we are now, and this is basically my focus, we are working on integrating with more institutional players and capturing some of the institutional flows as well. So we are speaking with payment companies, with custodians, exchanges, with order execution management platforms, which are being used by a lot of hedge funds and larger liquid funds. And we expect some of these partnerships to go live in Q2. These are obviously like driving a lot more volume than retail parties, and so we expect the institutional volume to really pick up over the next quarter. And actually, one of the biggest single unlocks for institutional conversations has been confidential intents that I mentioned before. The
Mhm.
pitch is really straightforward. Your positions are hidden, your strategy is protected, and but it's also at the same time compliant because you can issue few keys to whoever needs compliance visibility, right? Like your auditors, regulators, internal risk teams, etc. And this really protects users from front running, MEV extraction, strategy copying, really all things that make sophisticated capital allergic to transparent DeFi, right? And so that's the same execution privacy that institutional desks have enjoyed for decades and on centralized infra. And that's now available on decentralized rails for the first time. And yeah, I would say these are like the main priorities for us at the moment.
Mhm.
And we've been really seeing institutional momentum pick up a lot.
And Mr. Dance is abstracting weight chains, liquidity, and execution. Now, where does the complexity move, and who is bearing it?
Uh, yeah, so it's moving to the solvers, and that's very much by design. So how Intents works is basically you as a user, you express your intent or want to swap Bitcoin for ETH, right?
Mhm.
Then you have a decentralized network of solvers or market makers underneath who solve the best path to do that for you. So you as a user don't need to think about the complexity, right, of how do I swap. And so it's basically an RFQ system. And the user request is broadcasted to all connected solvers, which then compete, and then the best execution wins. So the closest analogy in traditional finance is smart order routing. So when you place an order through a broker, you don't need to think about which exchanges, dark pools, or market makers handle it, right? The router optimizes behind the scenes. And Near Intents brings a similar model to cross-chain crypto, except the brokers are basically, in this case, permissionless solvers competing on price and speed. And so, yeah, the user gets radical simplicity, and the solver network absorbs all the complexity. And yeah, in terms of who bears the costs, it's also the solvers, but they're compensated for it, right? They earn the spread between what the user pays and what execution costs. So the better solver is at sourcing liquidity across different venues, the more profit they capture. So it's a business model, not a charity, right? And that's what makes it sustainable.
And what differentiates a good solver from a bad one in the Intel system? And does this also naturally concentrate power among a few players over time?
Yeah, I would say what differentiates a good solver is the same thing that differentiates a good market maker in TradFi. It's basically access to deep multi-chain liquidity, optimized routing algorithms, fast execution, and then sophisticated risk management. Right, a bad solver will provide wide spreads, slower fills, and higher failure rates. So in a way, the system is self-correcting because users and agents naturally route to whoever gives them the best price. So bad solvers don't get selected, and they either improve or exit. And then on the concentration question, yeah, to some degree, yes, better solvers win more flow. The same way better market makers capture more volume. I would say that's healthy. It means users get better prices, but the key structural difference here is that, and difference from traditional market making, is that the competition is open and permissionless. So anyone really can run a solver. And yeah, I would say concentration risks exist in any market, but the architecture is specifically designed to prevent the kind of monopolistic lock-in you see sometimes in traditional market structure.
New intents grew from zero to billions in volume in a very short time. Now, what specific signal or sign would tell you that intent is real structural demand rather than mercenary capital rotating for incentives?
Yeah, I would say first, uh, basically persistence through the bear market, right? Like
Mm.
volume grew quite significantly from a few billion to now 16 billion, while the broader crypto market was losing half its value, right? So the volume didn't really go away. It actually accelerated, particularly obviously in up and down markets. Second, I would say the integration um, partners and ecosystem of wallets, DEXs, aggregators that are integrating intents is really diversifying rapidly and organically. So we started with a handful of wallets, and now we're live across 35 chains, 150 assets, and partners span wallets, aggregators, exchanges, privacy-focused products, and now in the next quarter also institutional platforms. So each new integration brings demand from an already existing user base. And also one thing I would add is we have done very limited marketing for near intents. So this has been purely organic cross-chain swap demand, which basically just came about because it's better infrastructure. Um, and then the last point is more around economic alignment. So I mentioned that we have this fee switch.
Mhm.
Near Intense is now, I believe, as of today, which is beginning of April, Near Intense is now generated over 28 million in fees, in collective fees. And so, with all the partners that we integrated, there is an automatic fee share if volume flows through the integration. So that actually creates, this fundamentally different incentive structure from liquidity mining, where you're essentially just renting volume, and then it disappears once the program and incentives end. So there is a lot of economic alignment with our partners.
What has been the hardest part in getting institutions comfortable with intents? Technology, execution risk, trust, something else?
Yeah, I think it's a combination of factors, and it definitely depends on the type of institution. The technology, I would say, is rarely the blocker. Once institutions see and understand, our underlying technology and our tech stack, I think they're usually convinced. So that tends to go smoothly. Execution risk was probably a bigger concern early on, but now that we have 16 billion in settled volume, and we have 5 years, 5+ years now of 100% network uptime, that has largely addressed that concern. What is one of the challenges, though, that we encounter is with institutions is that they have fundamentally different requirements, right, from retail traders. So these range from specific custody requirements. So they need to understand exactly who holds what on which chain, under what legal framework, etc. They have different requirements around, they need more sophisticated order types. They need to KYB or whitelist counterparties they're trading with. Some have credit requirements or delayed settlement, and also privacy, right? I think that's actually one of the biggest ones. And as I mentioned, confidential intents has genuinely changed the tenor of these conversations. So, execution privacy is language that institutions understand intuitively. It's not a nice to have. It's something that they actually need, and the reason why trading has stayed on centralized infra for decades. Um, so yeah, I think those have been the core challenges. But I will say that most of the conversations have really moved from okay, that's intellectually interesting to okay, let's talk integration timelines and fee structure. So that shift has really been tangible.
And but okay, do I understand it correctly? If intents become the default way transactions happen, does the concept of a blockchain itself becomes invisible to the end user? Because that's important, right?
Yeah, it's a great question and exactly right. That's exactly the end game we're playing.
Mm,
And I think we're closer than most people realize.
mm,
Near is actually like coming back to your point on sort of called chain abstraction. Near has actually been a big proponent of chain
mm,
abstraction. So if you want to onboard users at scale, you need to abstract blockchain away. That has always been our philosophy, and Near has actually been designed for this from the ground up. We had account abstraction and human readable account names from the beginning. So my wallet name can be my own name instead of this
mm,
hexadecimal string of gibberish, right? Um, Near.com, our own front end and super app, already delivers this invisible experience. So you can try it out. You can log on with your wallet, any wallet really. You can swap across 35 chains, and you generally don't have to care or know which blockchain
mm.
you're on. So we also have confidential mode now, as I explained, and we are also launching soon a product called One Click Earn, which lets you deposit into Aave, Lido, Camino, Morpho on any chain through a single interface. So you think about yield, but not about which chain it's deployed on. So that's the abstraction layer working as we have designed it. And then yeah, like the Q2 roadmap goes further. Like we are working on integrating prediction markets, RWAs, fiat on-off ramps. We're working on cards, even perps and derivatives, and they will all be accessible through the same seamless interface. And then for agents, that becomes even more natural. They express intents, and the system resolves them across whatever chains provide the best execution. So in that sense, like the chain is plumbing, not the product. And so we call it the unified commerce layer, where intelligence, execution, and settlement is deeply integrated into one stack. So it's built for humans today and for agents tomorrow. And we believe, and that has always been the philosophy on here, that's when you get real mass adoption and when technology disappears and only the utility remains.
Let's stop for a minute. Here's a brief moment of context for those who may not know me. My name is Nasib Fathi. I'm a scientific researcher in the blockchain space, and I work with executives and organizations as a growth and media professional. My focus is crypto at the intersection of institutional finance, market structure, and regulation. You are watching the NFK podcast, where these topics are discussed through conversations with people shaping the development of digital assets space. Now, speaking of AI infrastructure, a lot of AI infrastructure today is centralized. So, what is the strongest argument that this decentralized approach, such as Nears, can realistically compete on performance, data distribution, so on and so forth?
Yeah, I'd actually reframe the question slightly. So I think decentralized AI doesn't necessarily need to replace any
Mhm.
more than Uber needed to replace car manufacturers. It actually needs to win the use cases where centralized providers can compete, and those use cases turn out to be enormous. We believe privacy is the primary one. When you use centralized AI, your data goes, to their servers. You trust the privacy policy, and that policy can really change tomorrow, either through regulatory demands, an acquisition, a breach, or just a quiet update to the terms of service. So we have something called Near AI Cloud,
Mhm.
which basically allows you to run inference inside trusted execution environments where neither Near, so no one from our team, nor the hardware operator, nor the model provider can access your data. And on top of that, you get a cryptographic attestation, proving that the protection was real. So it's not a promise; it's verifiable math. So for consumer apps, that's there is a privacy concern. For AI agents transacting at scale with real capital, it's a systemic risk because if the infrastructure your agent relies on is compromised, every other transaction you ever made is exposed.
Mm.
And so we believe, our our tech stack, and I can talk more about also our confidential GPU marketplace, but I think that is sort of solving that issue, and you're seeing, with our NVIDIA relationship, how seriously this is being taken. Ilya, our co-founder, has now spoken at the NVIDIA GTC 3 years, in 3 consecutive years. It's actually he's the only Web3 founder that has been invited back each year. And we think that this confidential computing and privacy aspect of AI will become more and more important. And if you think about agents, in order for them to become really useful, they need to have context on your personal data. The more data you provide, the more useful they become, right? And so this is sort of like a big gap at the moment. We sort of blindly trust a lot of decentralized AI companies with our data, and this is something we want to address.
I like the connection between that and the parallel between Uber, Uber and manufacturing companies and centralized decentralized AI. I think it yeah, answers a lot of questions. Now, if millions, no. Before that, Near is building toward a model where agents can own assets, make decisions, transact. At what point do AI agents stop being tools and start competing with humans for capital?
Yeah, it's a very interesting question, and it's something that I'm very passionate about. It's sort of bringing together my capital markets background with our AI focus. I would say, in terms of when they compete with humans for capital, it's already happening, just in narrow domains, and most
Mhm.
people haven't noticed yet because they're looking for some, sort of dramatic moment. Um, I would say probably that transition is more like water slowly filling a bathtub, and not something that will happen like instantly. Um, like look at what's happening right now and across the industry. Visa just launched the trusted agent protocol that lets AI agents initiate payments on behalf of users. PayPal is working with OpenAI. Coinbase shipped X402, basically a protocol that lets agents pay for API calls with crypto in real time. Stripe is building agent native checkout flows. So these aren't really experiments anymore. These are production deployments, and they are coming from the biggest names in the space. So I would say the infrastructure for agents to move money is being laid right now. Um, on Near, we've seen this play out on the agent market. So we have an agent market where agents have completed hundreds of tasks autonomously, right? Like they can review code, security audits, data analysis, and some have placed, I think, 2,000 autonomous bits. So each one gets an on-chain identity with its own wallet and transaction history. And these agents are building, verifiable reputation, earning income, and are making autonomous economic decisions. So that is already moving towards becoming an economic actor. And yeah, I think the product trajectory is really hard to ignore. Everyone from, if you read all these like Morgan Stanley, Goldman Sachs reports project like, shopping agents driving billions in commerce in the next few years. And everyone from Visa to Solana to Near is racing to build the rails these agents will transact on. So I think the question isn't whether agents will compete for capital allocation, but it's how quickly and who builds the infrastructure they use.
If millions of agents transact, who are they actually trading with, right? So other agents, humans, or protocols, and what does that do to the market structure? I guess that the last part is the most interesting.
Yeah, I think initially it's mostly agents, humans, agents, and protocols. So agent A needs compute. Agent B provides it. They settle on Near, let's say. Agent C needs to review code. Agent D bids on it through, for example, the agent market. So the agents don't necessarily care if where they get this from is a human or an AI. It really cares about the quality, speed, and cost. So I would say agent to agent commerce is the first wave, and we're already seeing this going live. On the agent market right now, you'll find tasks ranging from build an NPC server for this API at 15 year, or audit the smart contract for vulnerabilities at 100 near. And then the agents are bidding on it and completing these jobs autonomously. Um, I think for the market structure implications, that's actually profound, because trading shifts from, discrete sessions, so the nine nine to five model, to continuous, 24/7 multi-chain, always on. Like agents can hire other agents for specialized subtasks, uh, and then create multi-agent workflows that would take me days, right, to complete. And then, so that's not incremental improvement to existing market structure. I would say that's more a structural transformation of how commerce works.
If AI agents start transacting at scale, who ultimately captures the economic value, the infrastructure layer, the application layer, or the agents themselves, or all of the above?
Yeah, I think it. The honest answer is it depends on a layer.
Mhm.
We're seeing a pattern emerge across the industry. So
Mhm.
historically, the infrastructure layer tends to capture the most durable value, like AWS capturing more profit than most of the applications running on it. Um, in the agentic economy, and this is just my personal opinion, I think we'll see something similar play out. Whoever controls settlement, identity, coordination rails, um, will have a structural advantage because every transaction has to flow through these layers, regardless of which agents or applications sit on top. You're already seeing this with like Stripe. Stripe is positioning itself as the payment layer for agent commerce. And on the crypto side, Solana and Near, they're both building agent infrastructure, but with different bets, right? Like Near is betting more on cross chain coordination and privacy. So I would say the risk for any infrastructure play, it may be commoditization, right? Like if agents are getting smart enough to route through whatever's cheapest, um, I guess like the defense is making the infrastructure so deeply embedded with real switching costs and network effects that it becomes the default rather than the option. So, yeah, in a nutshell, I don't have the answer. Historically, I would say the infrastructure layer. I would imagine this playing out the same way, but yeah, we'll see.
Mhm. And if agents control capital and make decisions autonomously, who ultimately controls the agents? And does that just recreate decentralized power under a different interface?
Yeah, it's it's very one of the most important questions, I think. In our opinion, it should be like who makes the decisions? It should be the user, full stop, right? Like that's the entire thesis of what we call user-owned AI at Near. Like, there's a lot of hype around OpenClaw at the moment. Obviously exploded in popularity, fellow Austrian behind it. And it does generally feel like magic, but there is obviously a lot of exposed instances. Directly exploitable via remote code execution. There's supply chain attack based on skills on its registry, all designed to steal credentials. So that's just not a hypothetical risk. That's what happens, when agents handle real money without proper security architecture. So I would say like the broader industry lesson is clear. Um, like and this is like I'm basically stealing a sentence from Ilya here, but from one of his latest interviews, like agent harnesses are basically the next operating system, and they also need the same security rigor, right? Um, we actually built Ion Claw, um, where every tool, so it's basically our version of OpenClaw, where every tool runs in its own sandbox. Credentials sit in encrypted vaults, so the LLMs can never touch it. And then on Near Cloud, which I mentioned before, the entire runtime operates inside these trusted execution environments, so these secure enclaves. And all of it is fully open source, so users can verify the security themselves. Um, Now, I think there was also a question on centralized power, right? Um, I would say if it could recreate centralized power, it absolutely could. if everyone runs their agents on the same centralized platform, right? That's why I think architecture matters. For example, IonClaw is open source. It runs on decentralized compute, and it gives users cryptographic control over agent permissions. So the goal and the I guess like the end goal is there isn't a better walled garden. It's to make walled gardens unnecessary, I would say. But yeah, obviously everything we're building towards on the new AI side has that whole security and privacy aspect in mind.
From your conversations with institutional investors, what are institutions' fundamental misunderstanding about AI and crypto, right? This connection that will cost them money over the next cycle.
I would say it's mainly two things. First is always around timing, right?
Mhm.
No one knows when this all will play out. To give you the example, right? Like Ilya and Alex Gidanov, they wanted to do vibe coding back in 2018 because they thought like all of this what we're seeing right now will be was already happening the a couple of years ago, right? And they were too early. So no one really knows the timeline of these things. But I believe like most investors and institutions think that AI crypto is maybe a story in 5 years. And they're building thesis decks and are doing research. But we already seeing um, agents earning near on the agent market right now. And the institutions that recognize this are already in conversations with us about integration. So
Mm.
while no one knows exactly the timeline, I think these things may happen sooner than we think. And the institutions that don't deal with this at the moment, I think, will be playing catch up in a couple of years. The second, fundamental misunderstanding, I think, is categorization. So obviously, there's a lot of fluff in the crypto AI industry, and most institutions tend to treat AI crypto as like this one big category, right? And since there's a lot of and a lot of the category is noise, there's a lot of meme tokens, vaporware, where tokens like bolted onto centralized APIs, they naturally dismiss the whole space. I think that's actually one of the biggest flaws in thinking, because AI crypto is actually several distinct markets. You have confidential compute, you have a cross-chain settlement, you have agent infrastructure, and so on. So each has different dynamics, different competitors, different timelines. And I think they shouldn't institutions shouldn't make the mistake of just dismissing the entire space because there is some fluff projects in the space. That's like dismissing Near or Solana because some AI token project is a scam. It's like dismissing Amazon in '99 because pets.com failed, right? So you shouldn't like generalize here. The smart money, I would say, is already making the distinction. And the question is, whether the broader institutional market catches up before the infrastructure winners are locked in.
Near has attracted institutional interest and partnerships. What do institutions actually believe will drive returns in Near, and where do you think they are most likely wrong?
Yeah, I would say, like going back to what I mentioned before, like clearly we have product market fit. Our tokenomics are in a very good spot, and we have generally like built a lot of wrappers for institutions. So on that side, I would say we are in a good spot. Um, what institutions generally believe will drive returns is definitely, we're already seeing a lot of revenue being generated from intents. So I think for them, we just recently released a revenue dashboard where you can track what Near Intents generates in revenue as a whole, and then how much of it goes to Near. Um, and then so that's on the intent side. I think the narrative framing, like AI and blockchain convergence, is directionally correct. Um, Institutions are right to see this as a major structural theme. Where they may be wrong is underestimating the near term revenue generation, right? So we have actually, I would say, like exceeded expectations from the market in terms of revenue that we have generated on the intent side. Um, and then where they might overestimate is the speed of agentic commerce maturation, right? So I was, and this might sound like a contradiction because I was saying a lot of that might come sooner than we think, but we don't know, right? And so, near structural advantage is like the timelines could stretch, but near structural advantage here is that the cross-chain settlement infra is generating revenue regardless of how fast AI agents adopt. Um, and the agentic economy, I would say, is the upside case we're building towards in the long term. But yeah, the base case is already pretty compelling.
You had to explain nearest risk profile to a traditional asset manager. Where's the real risk? So execution, adoption, or the broader AI thesis itself?
Yeah, I would say there is on the execution risk. As I mentioned, the products alive. We've seen a bunch of volume being settled already. We have had 100% uptime. Um, so that has sort of usually addressed concerns. But I will say that scaling, we're now doing like roughly 500 million a week in volume on near intents. Scaling that from 500 million to 5 billion in weekly volume will require continued integration work. We probably solver improvements, diversifying the solver network, relationship management with a lot of these integration partners. So that's I would say like a daily BD and engineering grind
Mm.
that we focused on. um, I'd actually say like competitive risk is a bigger one. Like everyone is building towards agent payments at the moment and cross-chain settlement. Like as I mentioned, Visa, PayPal, Coinbase, Stripe, they're all shipping agent commerce products right now. And then on the crypto side, you see other layer ones that are adding agent infrastructure. Um, I would say the features near bundles today could become table stakes tomorrow, but we have a real lead in privacy and cross-chain coordination. But yeah, I would say like we can't rest on it. We need to keep shipping, and that's exactly what the team is doing. I think everyone knows Near for the speed of shipping in industry and the tech stack. That's usually like how people the first two things that come to mind when people speak about Near. And then the last one is I would say a timing risk. If the Asian economy, as I mentioned before, like if it takes longer to materialize than projected, and given competition from both crypto native and traditional players, timelines could easily stretch. Um, but I would say like the macro projections that we're seeing are exciting, but they're not certainties. No one knows the timeline of which these things will play out.
This growing narrative that AI plus crypto is the next major cycle, right? Just repeating myself a bit, but what is the most widely believed idea in this narrative right now that you think is simply wrong?
Yeah, I think the first one that comes to mind is adding a token to an AI service makes it automatically decentralized AI magically. I think that's like a big um, misunderstanding. And it sounds absurd when you say it out loud, but essentially that's what many players in the market are doing. And also, some institutional capital has been allocated on that basis. Like many of these projects are just centralized API services with a payment token bolted on, right? So if you swap the token for something else, nothing about the product would really change. So the test I would encourage any investor to apply is like, does the AI actually need the blockchain to function? And I would say like Near passes that test cleanly because blockchain provides the settlement for intents. It's a trust anchor for confidential compute. It's the economic rails that you need for the agent market, and the identity layer as well. So the token isn't the wrapper on a centralized service. It's really I would say like the fuel that makes the machine run.
I have a follow-up question. If you had to put a percentage on it, how much of this AI plus crypto narrative today or AI plus crypto today would still exist without token incentives?
Uh, yeah, tough question. I don't know the exact, like, honest answer. I don't know the exact percentage. But I would imagine that you know a significant percentage of current projects wouldn't exist in the current form without tokens. And the projects that wouldn't survive are mostly projects where the token is the product. I think that those days are gone, where the days of where the token is the product. Um, and you won't be able to survive long term if the actual AI capability is thin or non-existent. And the token just exists to create speculative trading activity around an AI narrative, right? You see it constantly, like a project that launches a decentralized AI token but runs inference on a single AWS instance and then calls itself like Web3 AI infrastructure. Um, but I think the most important point, the underlying use cases would survive regardless of whether tokens existed. And that's the case for Near, right? Like cross-chain settlement, confidential AI compute, um, agentic commerce. These are real infrastructure problems. Real companies are willing to pay money to solve. And yeah, again, like Visa, PayPal, Google are investing billions in adjacent solution. For us, like the token model happens to be the best coordination mechanism we have for building these open, permissionless infrastructure at scale. And it's not the only reason these problems need solving. It's the best tools for solving them in a decentralized way.
AI is becoming a geopolitical asset controlled by a few jurisdictions. Now, if decentralized AI works, does it redistribute power globally or just recreate the same power structures in a different form? Now, we earlier had a question where there was this parallel, right? Uber, manufacturing, and so on. But the point is that I created this question because there is a sentiment, right? Whilst preparing for this, there are people even in the institutional space they're still discovering. Some are discovering both AI and crypto, right? After a while, after both existing for a while. So that's why I decided to ask it here. So if this is just, I will just repeat the question. So if decentralized AI works, how does it redistribute power globally, or just recreate the same power structures in a different form?
Yeah, I would say if you look at frontier AI nowadays, it's probably concentrated in maybe a handful of companies, mainly across two countries, right? If you are a developer in Nigeria or you're a hospital in Southeast Asia, you're a customer of big tech with no real leverage over the terms. And so where the decentralized confidential AI infrastructure comes in, it offers a genuine alternative, right? If you look at Near AI Cloud, it's accessible from anywhere. Our GPU marketplace lets anyone contribute capacity, and the
Mm.
agent market lets agents from any jurisdiction compete on equal terms. So I would say some concentration will persist, and hardware is dominated by Nvidia and TSMC, and training frontier models still requires massive amounts of capital. But a decentralized infrastructure can really democratize inference and agent execution, which is where most day-to-day economic value gets created. And where decentralized AI clearly wins is in preventing a case where two or three entities control AI for 8 billion people. And so yeah, I would say like decentralized infrastructure doesn't guarantee perfect power distribution, but it does guarantee that no single entity holds a monopoly on what is now the most important technology uh, of our day.
If the US, Europe, and China take fundamentally different approaches to AI and crypto, where does a protocol like Near win, and where does it get structurally constrained?
Yeah, I actually I think about this a lot because I've studied it. I've actually written my thesis at my master's degree on a comparative analysis between the Chinese and the European approach to AI governance. That was back in 2021. Um, I would say, and I've also worked across all three jurisdictions. So the way I am seeing it is, the US is obviously firmly pro innovation right now with the Genius Act, SEC clarity, and an AI action plan that promotes AI for the country. That's a tailwind, I think, for everything near is building. The EU AI Act is looks like a challenge on the surface, but actually, I would say Near's privacy by design features align pretty well with GDPR and the Act's transparency requirements. And so, confidential compute and user controlled data are exactly what European regulators would want to see. And then I would say China is more close to decentralized AI, but Near's infra serves growing markets, across Middle East, Southeast Asia, etc., regions with enormous demand for financial infra that isn't dependent on any single government. So I'd say the bigger picture is as governments increasingly treat AI as strategic infrastructure. Um, Probably the pressure to nationalize or tightly control AI labs will grow. So in that world, decentralized AI, in my opinion, isn't really optional. It's a very strong alternative to the current system.
There are projections of millions or even billions of AI agents transacting in the coming decade. If that happens, what role does Near realistically play in that economy?
Yeah, the way I see Near is really as the settlement and coordination layer. So more or less like the pipes where the value flows through. Um, Already like don't want to repeat myself too much, but I think Intense handles how value moves between agents across chains. And then the agent market that we have handles how agents find work and get paid. Ion Claw handles how they operate securely, and then confidential compute handles sensitive data. So together, that's a vertically integrated stack that I think no other competitor has fully replicated. Now again, I do acknowledge there is a lot of competition, but I would say like nearest bet is that as Asian economies mature past the experiment phase, and they start to handle like a lot of money and real business operations, that cross chain coordination and confidentiality will matter more than just speed, right? Which a lot of other chains are optimizing for here. Um, so yeah, I would say like um, whether Neo captures that depends on execution and distribution. But I do think our privacy mode is a pretty strong one.
Mhm. Okay, here's the closing question. Where is the best place for listeners to follow your work and stay updated on what Near is building?
Yeah, so feel free to, first of all, I would say like check out near.com. I think that's if you want to try our front end, our super app, it's honestly the best way to understand what near intense actually feels like in practice. You can swap across a few chains, toggle confidential mode, and again, like soon you will be able to trade like tokenized equities, gold, and deposit yield on any chain, deposit into yield protocol on any chain. And then I would say like feel free to follow New Protocol on Twitter, and specifically if you want to follow the AI progress, follow Near AI and Near Intense Twitter accounts for anything intense related. And then yeah, feel free to also follow me personally. My name on Twitter or X is Alex underscore Scharrer. I post regularly about institutional adoption and capital markets development, and I try to be honest about both the progress and the challenges. And then I would say, like as a last, call to action, I would say if you're an exchange, trading firm, payment company, or RWA platform that is interested in integrating Intense, you can reach out to me directly. I think we're building something that I generally believe will be infrastructure grade settlement for the next generation of finance. So I'd love to have that conversation with anyone who's serious about the space.
I'll include all the links in the description.
Awesome.
Alexander, thank you very much for the conversation. And to everyone listening or watching, like, subscribe, or follow both of us. Check out Near's website and share this episode with someone curious.